Welcome to Variety Time Videos. In today's video, we're going to break down a question that affects travelers, businesses, and entire economies. What actually affects exchange rates? We'll cover the main factors, explain them in simple terms, and show how they impact you in everyday life. Let's dive in. The role of supply and demand in determining currency value. At the most basic level, exchange rates work just like prices in any open market. They are shaped by supply and demand. When more people, investors, or businesses want a particular currency, its demand rises, which drives up its value. On the flip side, when fewer people are interested or when investors pull their money out of that country, demand falls and the currency tends to weaken. This constant balancing act happens every day in global financial markets, making exchange rates some of the most dynamic prices in the world. Demand for a currency can come from many different sources. For example, when a country exports a lot of goods and services, foreign buyers need that country's currency to pay for them. Similarly, if international investors see opportunities, like buying stocks, real estate, or government bonds in that country, they need the local currency, which pushes its value higher. Even something as simple as tourism can play a role, since millions of visitors exchanging money to spend locally create additional demand. But supply also matters. If a government or central bank increases the money supply too aggressively, such as through printing more money or lowering interest rates, it can flood the market with currency, reducing its value. On the other hand, when supply is controlled and demand is strong, currencies gain strength. In short, just like with everyday products, the price of money itself is constantly adjusting to balance supply and demand forces, inflation, and how rising prices influence exchange rates. Inflation, the rate at which prices rise over time, is one of the biggest long-term drivers of a currency's strength. When inflation is low and stable, people feel more confident that their money will hold its value in the future. This builds trust, not just for locals, but also for international investors who are more likely to buy assets in that country. A currency tied to low inflation often becomes stronger over time because it represents stability and purchasing power. On the other hand, when inflation is high, the opposite happens. The same amount of money buys fewer goods and services, which means the currency is essentially losing value. Investors notice this quickly, and they often move their money out of that country to avoid losses, causing the currency to weaken even further. High inflation can also trigger a vicious cycle. Once people lose confidence, they may start spending or converting their money quickly, which puts even more pressure on the currency. The link between inflation and exchange rates is especially visible when comparing countries. For example, if one country has consistently higher inflation than its trading partners, its currency will usually depreciate over time. This is because foreign businesses and investors prefer to deal in stronger, more stable currencies. Central banks often step in by raising interest rates to fight inflation, which can temporarily strengthen a currency. But unless inflation is brought under control, the long-term outlook remains weak. Interest rates and their powerful impact on currency strength. Interest rates are one of the most direct levers that central banks use to influence their country's currency. When a central bank raises interest rates, it essentially makes holding assets in that country more rewarding, since investors can earn higher returns on savings, bonds, and other financial products. This naturally increases demand for the local currency, because foreign investors must convert their money into it before they can take advantage of those higher rates. As demand rises, the currency strengthens. The opposite happens when interest rates are cut. Lower rates make a country less attractive for investors seeking returns, and some may move their money to other countries with better opportunities. As money flows out, demand for the currency drops, leading to depreciation. This push and pull is why even small changes in interest rates often cause sharp reactions in foreign exchange markets. Traders and investors watch these decisions closely because they can create opportunities or risks within hours. Political stability and economic confidence as key drivers. Currencies are more than just numbers on a screen. They represent trust in a country's political and economic system. When a nation is politically stable and governed with transparency, both local citizens and foreign investors feel confident that their money is safe. This confidence translates into stronger demand for the country's currency, which often strengthens its value in the global market. Stability doesn't just encourage investment, it also reduces risks, making the currency a more reliable store of value. However, when political instability enters the picture, the opposite effect takes hold. Events such as corruption scandals, leadership crises, or protests can trigger fear among investors. Even the possibility of sudden policy changes can be enough to shake confidence and cause people to move their money elsewhere. When that happens, demand for the currency falls, weakening its value. In extreme cases, prolonged instability can lead to severe depreciation, making imports more expensive and worsening economic conditions at home. It's not just politics. Economic confidence plays an equally vital role. A country with strong institutions, predictable policies, and healthy long-term growth will naturally inspire trust in its currency. On the other hand, nations that struggle with economic mismanagement or uncertainty about the future will see their currencies suffer, even if short-term factors look favorable. In the end, trust is everything. The more people believe in a government's ability to maintain order and manage the economy, the stronger its currency tends to be. Trade balances, exports, and imports affecting currency flows. One of the biggest long-term drivers of a currency's strength is a country's trade balance, the difference between what it sells to the world and what it buys. When a country exports more than it imports, it creates a trade surplus. This surplus strengthens the local currency because international buyers must first exchange their money for that nation's currency in order to purchase its goods and services. The higher the global demand for those exports, the greater the demand for the currency, which naturally pushes its value upward. On the other hand, a trade deficit, when a country imports more than it exports, often puts downward pressure on the currency. In this case, the country must send its own money abroad to pay for foreign goods and services, increasing the supply of its currency in the global market while decreasing demand. Over time, persistent deficits can weaken a currency significantly, making imports more expensive and potentially creating inflationary pressures at home. This is one of the reasons governments and economists watch trade figures so closely. They provide clues about the future direction of currency movements. However, the impact of trade balances isn't just about raw numbers. The types of goods and services being traded matter as well. A country that exports high-demand commodities like oil, natural gas, or technology products will usually see stronger currency support than one that relies heavily on importing essential resources. Similarly, global demand shifts, such as a surge in energy needs or changes in consumer preferences, can quickly alter a nation's trade balance and, by extension, the strength of its currency. In short, trade flows act like a constant pulse on the health of an economy, directly feeding into the demand for its money. And that's the simple breakdown of what really affects exchange rates. From supply and demand to politics and trade, so many factors shape the value of money each and every day. We truly appreciate you watching Variety Time videos. If you found this explanation helpful, please like the video, share it with friends, and kindly subscribe to our channel for more easy-to-follow guides on money, science, and everyday life. For more helpful tools, resources, and exclusive recommendations, please visit our store at varietytimeproducts.com, where smart choices meet everyday convenience. Stay tuned, because we have more insightful content coming your way very soon.